Hi, this is Hyperwave. We have seriously missed you guys. It is Sunday. I'm Leah Wald. We have Ty here today, and we're going to be as provocative as possible on this one because we've been getting a lot of slack on something that we love talking about, which is being big nerds on the Fed, stock markets, bonds, indices. I was obnoxious about the Chinese equities today. And pretty much we are maybe going to posit, maybe not, the idea that the Fed has completely stepped out of their range of powers. They weren't supposed to do what they have currently established their stronghold to be. However, it ended up being extraordinarily effective. There's some history behind it. And there's importance to understanding this, not only so that, you know, you can have some knowledge to back it up, but also so that you make sure your portfolios are nice and strong. So, Ty, go be more provocative than me, please. No, you're on mute. So while we wait for Ty, it's Sunday. I'll let you know when I can hear you, Ty. Well, also what we're going to bring up is Ty's tweets that he's been having that has gotten, what does this one have, like 300 people that were angry about it. So it's epic. So this is going to be really good. I'm waiting for Ty to come back in. And there he is. Tyler?
Great. Thank you.
Hey, all right. There we go. All right, Dr. Hyperwave.
Perfect. Leah's pulled up some of the tweets that I came out with in the last couple of days that caused a lot of concern. People saying that they were inconsistent and that a couple of them actually were antithetical to each other, having to do with the Federal Reserve. And I started off by saying this is very difficult for me to write, particularly in the format of Twitter, where you've got to be very brief and succinct. And this topic is just so huge, it's difficult to, almost impossible to do. I tried the best I could, and we're going to recap what I was attempting to say and why I stand 100% behind it. It's taken me years to come to this conclusion. I've been a big critic of Alan Greenspan, particularly from the period of 2000 to 2006, and his successor Bernanke, and then Yellen, and then Powell today, just because of the solution that they found to make sure that we advanced the ball. And that's a metaphor I should have been using all along when talking with the Federal Reserve. In golf, you find yourself in very difficult positions sometimes, in the woods and deep rough. No clear way to make your next shot all the way to the green. And the rule is with really, really good players is what you want to do with every shot is simply advance the ball. If you can only do it 20 feet, but it's in the right direction, that's the way you have to go. If you take too much risk and try to plow it through the trees, you end up losing 3 or 4 strokes. So what you try to do is advance the ball. And what the Federal Reserve found themselves faced with after the booming period from 1982 until the year 2000, where everything was going right. Interest rates were coming down, corporate profits were going up. The stock market had the best 5 years in its history from 1995 to 2000. Everything was great, and then everything was not great, almost overnight. And it became so serious that new innovations and interpretations of what the Fed could do and couldn't do started being used. Okay, so that's the background. And everyone was sort of horrified by what they were doing. And what they were doing is just printing a whole lot of money, fiat money that was not backed by anything, and expanding their balance sheet in order to buy bonds to force interest rates down. And that didn't really get going until 2007, 8, and 9 with the mortgage debacle. And they got tremendously creative during that period. So economists all over the world began debating, okay, you've gotten us into this mess. How are you going to get us out of it? Or is there any way to get us out of it? Have you painted us so far into a corner that we will never recover? And in 2010, 11, 12, 13, things were kind of sputtering, but going up. And then in 14, 15, 16, they really started going up. And now everything seems to be in line again. And I will define what I mean by in line. But Leah, why don't you start with just the first tweet, and we'll go through that one. And then there's 4 of them all together. And then we will try to explain what I meant and what I still mean. And I will give you a very specific example of what I believe is going on.
Tyler, you have more than 10,000 followers.
Wow.
All right. So this is the first time you're mentioning US stocks, and then it's going up. So which one would you like me to begin with as they continue? Probably difficult series of tweets, I'm in all.
Yeah, why don't we start with that one? Because I knew it was going to be difficult to find the right words.
Okay, I'll read it. This is a very difficult series of tweets. I am in awe of what the Federal Reserve has accomplished since 2000 under Greenspan, Bernanke, Yellen, and so far Powell. Included are the members of the Open Market Committee. I never believed they would be so successful. I was wrong.
Okay, let's just start there. That's the starting place. I woke up in the middle of the night kind of with this realization that even though I've been very critical and I do not like the techniques that were used, and I believe the techniques that were used have put us into a more dangerous position as each year went on. So I am not in any way saying that the Fed found a magic bullet and therefore I am in awe of what they accomplished. Quite the opposite. They found a very intriguing way of, for the first time in history, for any central banks anywhere in the world to come up with basically a gimmick that had almost zero possibility of working, except for one thing: it worked. Now, what does that mean that it worked? Simply put, they were able to advance the ball from the bottom in March of 2003, after the stock market had fallen 50%, the Twin Towers had come down, the first time the US, continental US, had been attacked by a foreign power. And Alan Greenspan quickly cut interest rates down basically to zero and kept them there. And many argue, including myself, they kept them there too long. And by keeping them so low after the bottom in 2003, as the markets began to expand in 2004, 5, 6, and into 2007, it created a massive bubble in real estate and in mortgages and in collateralized bonds and in the securitization of all of those. Now, the Fed didn't cause Wall Street to do what they did. But if the Fed had not done what the Fed had done, Wall Street would not have been able to create all of the tranches that they did among the junkiest of the junk, which then caused everything that followed. So I am not excusing them for laying the groundwork, putting the mines throughout the battlefield, making it almost impossible for anyone to cross the battlefield without a series of enormous explosions taking place. And that's exactly what happened in 2007, 8, and 9. So why am I in awe? I'm in awe because the probability of them being able to pull that off was so infinitesimally small, but they did it anyway. So let's go to the next tweet. And here,
yep.
Yeah, why don't you read that one?
The centralization of the Fed since 2000, the enormous expansion of their mandate, their tactics, and their power has been very troubling to me. But it has been necessary, in fact, essential. The macroeconomic landscape would be seriously degraded if not for their actions.
Okay, there's 2 or 3 important points there. And a couple of responders to this tweet and the others jumped on the fact that I said that the landscape would be seriously degraded if they had not acted. And in another tweet that we will read in just a minute, I said that the result of what they have done has seriously degraded the landscape. But it seriously degraded it after getting us out of that first mess and getting us out of the second mess. And now, as we are pulling away from that, meaning GDP is growing, corporate profits are growing, income is growing, and the stock market is booming. That doesn't mean that the territory, when you look outside the window, is not very, very dangerous. So what I said was that 3 or 4 things has occurred since the year 2000. An enormous expansion of their mandate. Their original mandate was they could do one thing. They could increase or they could decrease the Fed fund overnight lending rate to Federal Reserve banks, period. But then all of a sudden, they started using all kinds of other tools that they had never used since they came into existence 1912, 1913. And that's what I mean by an expansion of their mandate. Now, is it possible we will ever be able to reduce those tools? I very much doubt it. Because when any major institution gains power, it's almost impossible to reduce that power. And the power that I'm talking about, the tactics in their power, has been what has been troubling to me. So what I'm saying in these first 2 tweets are, first of all, I'm amazed they were able to pull it off. Secondly, I'm very troubled by the new Federal Reserve, the powers that they have, unchecked by Congress, by the president, by the judiciary, are and have been in a position to, on a macro basis, either put us deeper and deeper into this credit debt bubble, or by slowly raising interest rates, they could actually alleviate that pressure over time if two things happen. The economy continues to grow at a rate faster than the interest on the money that has been borrowed in the form of buying the bonds. And right now we are above that level, which means that as long as we stay higher than the rates on government bonds in terms of the growth of the GDP, we're actually going to be alleviating that bubble. But when the next recession comes, if and when it does, it will probably be much bigger and much.
Lost you for a sec, Ty. Yeah. Try just pulling out the snowball. Nope. Oh yeah, Ty. Still silent. Yeah, that's totally true. I do see your guys have really good questions. I tried to send the link. Nice. Nice. Tyler's coming back on. All right. Hey, Ty.
Hi. Yeah, the nickname of my computer is Hal. Whenever I start talking about things it doesn't like, it goes blank. Okay, so let's pull up the third tweet.
All right. Fed action has left the macroeconomic landscape very seriously degraded. But without it, we would not be facing the opportunities we now are facing. Back in 2010, speaking with groups of clients with the Dow Industrials below 10,000, I predicted a 10x increase in my lifetime.
Okay, so here's the point of all of these tweets. The Fed did the only thing, in my opinion, and the opinion of many, many economists today looking back, that had any chance of being effective. One. Two is the actions they took increased the possibilities and probabilities of greater problems later. Three, those greater problems later began in 2007 and ran 2008 and 9. And that situation was far more serious than the one that Alan Greenspan had taken care of by this experiment. Four, that last series of unbelievable actions taken by the Fed worked again. And this time, instead of just having 3 or 4 years of relief, we've got 10 and counting. Now, I very clearly said in this tweet that Fed action has left the macroeconomic landscape very seriously degraded. They took the actions originally back in 2001, 2, and 3 to alleviate that degradation. It caused a momentary bounce of 3 or 4 years, resulting in bubbles that they could no longer control. And then they took even greater action. And a lot of people, including Hank Paulson and Geithner and Greenspan, as well as Bernanke and later on Yellen, believed that we came within a short number of hours or days of seizing up worldwide in terms of the financial markets. I agree with that. I believe that's how close we came. But this second time, all of the various programs in terms of buying back, first of all, the U.S. treasuries, and then mortgage bonds, and even association bonds, Fannie Mae, Ginnie Mae, Freddie Mac, worked the second time. And following March of 2009, when the stock market was bottoming, the recessions began to come to an end, and we've been moving up ever since. So what these tweets are saying is we are all very lucky that the Federal Reserve has been pounding on the end of atomic bombs with a hammer for going on now 18 years. And the first time they were able to straighten out the bomb without it blowing up. The second time, it looked like it was going to blow up, and they kept pounding on it, and they got bigger and bigger hammers, and it finally worked, and we've been growing ever since. But the background behind the problem, credit growth, the issuance of enormous amounts of fiat dollars, the 4 trillion plus balance sheet of the Fed has only recently begun to diminish, and not nearly quickly enough to alleviate the degradation of the overall macro scene. Okay, let's just go on to the last one, and then I'm going to pull up a chart which is, to me, the most important thing, which is how are markets reacting around the world to what this sequence of events with the Federal Reserve has been. Do you want to read that one, Leah?
I had myself on mute. Yeah, is that the one that you wanted, the last one on the Dow?
Yeah.
Great. The Dow Industrials have increased 3 times since then. They're 3x since then. There's much more to come. I did not anticipate an administration so doggedly insistent on focusing on United States growth, corporate profits, job creation, lower taxes, and improved trade balances. These don't assure success.
Okay, there's a lot in here, but the previous tweet said that 10 years ago, 8 years ago, actually Leah's brother, and I think, I can't remember, but I think Leah attended down in Bethesda, Maryland. We held a meeting with a number of clients and potential clients, and then we did that again a month later out on Long Island, and then we did it again in New York City at the 21 Club. And what we were saying in 2010 was that what the Fed had been able to pull off was going to result in, along with growth in technology over the coming decades, an expansionary period in which the economy would get stronger and stronger and the stock market would go higher and higher. Now, none of my tweets talked about that specifically, but this last one just makes the point that since I predicted a 10x increase in my lifetime, we've already had a 3x increase since 2010. That's what I mean by the stock market has tripled after the Federal Reserve took all of that action. And the GDP has now gone from 1.5% average worldwide, and in the US to over 4%. So I threw in a little political statement because this is something 10 years ago I did not ever imagine happening, which was that someone would be elected to the presidency against all odds on the basis of getting the US to grow again and spending more time thinking about the guts of this country as opposed to our relationship with all the other countries of the world. And the result of that, in my opinion, up through today, is that we have increased the US growth rate, corporate profits, job creation through lower taxes and what is quickly becoming improved trade balances. That last one is not finished yet and could go horribly wrong. But what my point is all of this economic theory, macro or micro, to me is a bunch of talk. And it is like walking around in the cloud trying to figure out direction. That's why I have become a technical analyst, because we can debate the politics or the economics or the ethics or the morals of everything that is going on, but that's not the business I'm in. I'm in the business of telling clients what my best take of the risk and reward of various investment classes are. And you all know how I feel about crypto and Bitcoin. I feel that they are in a downtrend and have been for 8 months. And I see no evidence of that downtrend ending. We have been in a flat stock market for the last 8 months, but it has recently broken out to new highs and is no longer in a flat trend. It is now in an uptrend. And because of that, Leah and I have been saying in as many ways as we can, the less risky investment with the greatest return right now is not Bitcoin, is not the cryptos, it's not international stocks, it's not bonds, it's US stocks. And all of these tweets about the Fed are to lay the groundwork for understanding how we got from there in that mess to what appears to be the beginning of another major move upwards in the economy and the stock market. Now, a bunch of the people that don't particularly cotton very well to these comments have been saying, first of all, you're admitting that the macroeconomic picture is worse than it's ever been. True. But we never would have gotten this far if it wasn't for everything that I have just said. Does that mean we're out of the woods? No, in no way does it. If you've been listening to our vlogs, you know how nervous I've been about the stock market since January. But piece by piece, first the NASDAQ and the NASDAQ 100, and recently in the last 10 days, the S&P 500, and even more recently, the Dow Jones Transport Index, which is half of this very important thing called Dow theory, has gone to all new time highs. And the only one that hasn't is the Dow Jones Industrials. And we're only a couple of percentage points away from that happening. So that was the context that I was talking about. I just wanted to clarify it. And then we're going to take a look at one chart here very quickly.
Got it.
Okay, Leah's pulled up a chart that Tone has used before. And what it shows are these three periods in history that I've talked about since you first heard our vlogs back in January. And that is that from 1908 to 1922, the market went flat and then exploded upwards in a hyperwave. And then it took from 1929 to 1953 to get back to the 1929 highs. Then we had a very strong period in the 1950s following World War II, all the way till 1965, in which the market basically went from about 200 up to 1,000, a 5x move, and then stalled out from 1965 to 1982. 17 years in which the Dow Jones Industrial Average could not get above 1,000 until Paul Volcker, at precisely the right time, which was at the peak of that giant hyperwave that we have shown in the credit markets that started in 1942 with interest rates moving up. And they continued to move up all the way until 1980. Up the entire time, 40 years, in a hyperwave that then peaked in the phase 4 and began its long crash starting in 1980 and still going on today, some almost 40 years later. And it was because of what the Federal Reserve did under Paul Volcker in 1979 and 1980 and 1981 that we then moved out of the flat period from 65 to 82 and started this monster move from 1982 all the way to the year 2000. But then we ran into the same thing that we had seen historically, a period of flatness that ran with the NASDAQ from all the way in March of 2000 until just 2 years ago, 15 years, where the NASDAQ could not get back above its old high. The Dow and the S&P did, but they went through a 10-year period from 2000 to 2010 with no upward movement. Okay, that brings us to today. And now I'm going to pull up another chart.
You're on the screen.
Okay, I'm going to pull up one of just the Dow. From 1900, looks very similar to the chart we just looked at. But I want you to see up close this period, which is the one I've just been talking about, the Federal Reserve. And during this period, we had these two tremendous crashes, the second one worse than the first. And ever since then, we've been moving up. Now, we're going to post a link to a group that has done a lot of analysis on long-term trends in markets. And they've got a video out that Leah will post on this Hyperwave channel after we're done. And you should watch it. It's about a 20-minute video analyzing these periods and what resulted after the flat periods. And from that, they are predicting, and I would agree with them because I've still got to go from the 10,000 to currently just below 30,000 all the way to 100,000 in a fairly short period of time for my prediction to be correct. And I see nothing with this recent movement in the stock market breaking out to the upside that tells me that that is incorrect. And therefore, we are big believers in the US economy, in the US stock market. And we believe that it offers much greater returns with much less risk than any other asset class around the world at this point. Now, once again, that's pretty highfalutin talk. So I need to put a caveat on that. Going back to the tweet saying that the macroeconomic picture is very seriously degraded. We've seen what's happened with localized governments that have run amok, like Venezuela and Turkey and Italy, and to a certain extent, Portugal and Spain, and many, many other lesser nations around the world that are struggling mightily right now. And to the extent that that expands because of the amount of debt or credit, we could at any moment face another very serious problem. So I am not telling anyone that I am recommending buying and holding stocks. I am saying that the stock market in the US is currently in a very clear bull market. It is in a very clear uptrend, but you should be very nervous, meaning don't buy with the idea of putting it away and never looking at it again. Leah and I have been introducing some concepts like consensio that help you, and you can do it on your own once a week, once a month. Just check the short-term, the intermediate, and the long-term moving averages to see where the prices are relative to those averages. And if you see signs that the price is slowing down or rolling over or cutting through the short-term moving average or the intermediate moving average, or the short term is cutting through the intermediate moving average, any of those things are signals, and we'll be here and we'll be doing our vlogs and we'll be following it, and we will be giving you our very specific recommendations of how we interpret it. Those tweets were done very specifically because none of those things are happening now. Therefore, you've got an asset class which happens to be the largest in the world in terms of equities, not the largest in terms of the bond market, which is much larger than the stock market. But in terms of equities around the world, it is the world's largest equities market, meaning it is very, very easy to get into and out of. We've had 2 or 3 shows where we've talked about ways that you can defensively protect those positions using options, using inverse ETFs and mutual funds at various times so you don't have to worry about immediate tax implications, as well as being able to move very quickly without having to dump a bunch of positions. So we wanted to clarify all of that today and just be a lot more specific about exactly what we were talking about in those tweets. And with that, I'm going to turn it back over to Leah because she has other things to do, as all of you do, and I do too.
Yeah, I'm going to my favorite jazz club. So thank you, Ty.
Right.
I don't know why I always get reverb. Oh, that's better. Yes, you have really good questions. So I think that we should make a follow-up to this one, but thank you, Ty. Options. Yes, we will. We have a lot of fun shows that we're going to continue with. So everybody, thank you so much. Maybe I'll send a little video from the jazz show. Would love to hear your guys's, if anyone here is jazz buff, your favorite jazz artist. Tyler, what do you think of jazz actually? What's your favorite?
I love jazz, you know, all the way from the early jazz, Louis Armstrong, all the way through
Satchmo.
The Marsalises, and just everything. It's one of my favorites. But I am very eclectic. I will go from very deep, heavy Bach and German classical. I love Russian classical. I love very hard rock. I love Stevie Ray Vaughan and Martin Knopfler, and I love virtuoso instrumentalists. I love country. So there's very, very few things I don't like to listen to, but sitting around on a day like this, jazz is about as good as it gets.
Absolutely. All right. Someone put Bill Clinton. I thought that was pretty funny. All right, everybody. Thanks so much for watching. Thanks, Ty.
Okay. Thank you, everybody.